Did you know that one seemingly simple equation holds the mysteries of the entire universe of accounting? It's true. And I'm about to unlock those mysteries for you because that's what I do. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. Let's jump right in. So the accounting equation is so important to accountants that some of us, well, one of us, has had it imprinted on a t-shirt. Now, what is it about the accounting equation that holds so much magic? Well, let's explore that. So the accounting equation looks quite simple. It's assets equal liabilities plus equity. Three little things that hold so much magic. So let's start with that concept of the equation. So the accounting equation must always be in balance. Okay, let's start there. That means if you do something on one side of the accounting transaction, the other side of the accounting transaction must also be the same number when you're done. So if you add $1 on one side, you've got to add $1 somewhere on the other side. If you add $1 and subtract $1 on one side, the other side will also end up being zero. So what we're doing is we're tracking changes in that accounting equation. And those changes are what we would call transactions. So you buy something or you sell something. And every one of those transactions creates a change in the business, and therefore it creates a change in the financial situation of the business. So it changes our financial statements. So let's talk about each one of those components of the accounting equation. The first one on the left-hand side is assets. So assets are something that a business owns. So it could be cash, it could be inventory that we bought to sell to our customers, it could be a piece of equipment or a vehicle or a building. Those are all examples of assets. It's something that the business has that has value. Another type of asset would be something called accounts receivable. And accounts receivable exists because you have sold something to your customer and your customer hasn't paid you yet. You're owed the money by your customer and you expect that you will get paid for it, but you don't have the cash yet. So accounts receivable is a holding tank for the money that is owed to us by our customers. So it's an asset because it has value, and the customer will eventually pay us that money, which will then move it from accounts receivable to cash, another asset. Now let's jump over to the other side of the equation and talk about liabilities and equity. So when we're talking about liabilities and equity, we're talking about what the business owes. So assets are talking about what the business owns, and liabilities and equity are about what the business owes. So when we're talking about liabilities, this is what a business owes to someone else. So we owe money to a supplier, or we owe money to a bank, or we owe money to a government taxing agency. So that is what we owe to third parties, somebody outside of our organization. But we also have a debt, a liability to the owners of the company. And if it's a single owner business, then this is what we owe to that person who has invested their time, money, blood, sweat, and tears into the business. If it is a business that has partners, we're looking at how much each partner has in worth in the business, that if we were to close the business today, we would be paying out to them in theory. If it is a business that is a corporation and it has many owners, then we're looking at what we owe to all of those different owners. So on the right-hand side of that accounting equation, we have what the business owes, whether it is to a third party like a vendor or a bank or to the owners. So another way of stating this would be assets minus liabilities equals equity. And the easiest way to understand that would be if you own a house and you have a mortgage. So you own a house that you paid $200,000 for, you owe the bank $180,000, and so your equity is $20,000. So that's what we're talking about when we're talking about assets, liabilities, and equity. Now, within that liability section of our accounting equation, we have a variety of accounts that could be there. So the first one that we would expect to see very commonly would be accounts payable. So accounts payable is when you have bought something from a vendor and you're going to pay for whatever it is you bought, maybe it's inventory, you're going to pay that bill in 30 days. So that is accounts payable. You owe money to someone else. Other accounts that you would expect to see in liabilities that would be very common would be if you have a car loan on a company vehicle. So within our accounting equation, that would be a liability. It is money that we owe to a third party. So we would see that in our liabilities section as an account that would be called something like note payable big bank. You might also have something like sales tax payable. So you are collecting sales tax when you sell to a customer, and you are holding that in trust for the revenue department of the state that you're collecting it for. You could also have payroll tax payable. Again, this is money that you owe to a third party, in this case, a government body of some sort. Now, on the equity side, we've got a few things going on here. So the first one would be that the owner of the business, whether it is a single person who owns it or it is a group of stockholders who have bought stock, those are investments into the business. So the owner says, I'm going to put in $50,000 of my money, or the stockholders say, we're going to buy 100 shares of stock each, and that money goes into the company. So these are owner investments. So that's part of what's going to be in your owner's equity type accounts. Now you would also see something called owner's draw or owner's withdrawals or dividends. And that would be a situation where the owner is actually taking money out of the business. So I put money in, and now I'm going to take some of that money back out. So if it's a corporation that's paying dividends, that's what's happening there. They are reducing the equity by taking money out and giving it to the shareholders. If it's a business owner who has put money in, who is now taking money out, he or she is reducing their equity in the business because they're taking some of that money back out. So the business owes them less. The other thing that you will see within that equity section would be something called retained earnings. And what retained earnings is it is an accumulation of profits and losses over time. So when a business has a profit, the owner, whether it's a single owner or partners or shareholders, when there is a profit, their equity increases because they have now more value in the business. When a business has expenses that exceed their revenue, they have a loss. So a loss has the impact on the accounting equation of making equity less. Now, over time, you have profits and losses every month moving forward, and that all ends up in this account called retained earnings. And if it's a positive number, that's great. It means that the business value has increased. The owner's investment has earned a return. But if you have a lot of losses and you end up with retained earnings that are negative, it means that the investment is not paying off so well. Not good. So within that equity piece, we've got owner's investments, we've got owner's draws or dividends, and we've got retained earnings. So every time a transaction happens, it impacts at least two accounts within that accounting equation. Now, it could be all on the asset side, or it could be all within the liabilities, or all within the equity section, or it could be just between liabilities and equity. So all of those transactions, regardless of where they impact, it needs to come back to that equation. It has to equal. And there you have it, the accounting equation demystified. Be sure to check the description box for other videos that will help you to understand the basics of accounting. Until next time, keep it balanced. We'll talk to you soon.